Hello, everybody. This is Stefan Dutay at TradingCandles.com, June 12, 2014. We're going to start with our disclaimers. We are not a licensed financial advisor or broker-dealer. This video is for educational purposes only, and the viewer should do their own due diligence before making any financial decisions or investments. So tonight we're just going to have a quick recap of what's going on in the market today and this week. And one of the big questions is the market going to keep going down? As we've been discussing in previous videos and blogs recently, we have hit our price target up here at 195, and we've also pulled over 10% off our moving average here. So we thought we may have a pause in this area. So we already are having our pullback. The question is, how far will this pullback go? We have our MACD rolling over. Nobody ever knows. This is a very strong trend. But in our opinion, this first primary trend line is not being respected. You can see that the price is just breaking through it quite a bit. Nor is this 50-day moving average being respected very much. So if you look at your first point of support and resistance, it's going to be right in here at about 1890, which is actually the 50-day moving average, coincidentally. And then below that, we have our 125-day moving average. So if you were to ask us, we went and looked, and if it was a, I hate to say major, but if it was a good-sized pullback, I would say anywhere between 1890 and 1850 are possibilities for a pullback. So that's that. That's nothing new. If you have questions, just check out our earlier videos. It explains it all quite well. And I'm using a 6-month chart today to try to make the video a little bit clearer. I wanted to point out one of our trades. We had a position in IYT, which is the Transportation Index, and this supports the Dow Jones. So when the Dow Jones is going up, this should be going up with it, and vice versa. We get to this area in here and decided to take our profits and move them over to XOP, which is oil and gas exploration. We moved it over there because you noticed the MACD here is coming up, and it was actually starting to come down on the other side. And this just had some more momentum. So we picked this up on 521, which is right here. So we bought it right on this bounce. There's two hammers right here, hammer, hammer, bounce. And we wrote it up, and we actually closed our position today. We picked up 4.9% in 7 days. That's really a huge return. I mean, on the low end, even if you did not compound that, that would be a 300% return per year. And if you compare that return to the, if we had held where we were, we may have broken even most likely. Maybe get 1% or something out of it. So that was a good example of rotating from one sector that was becoming weak or showing signs of being overbought and entering a sector that was gaining momentum. So we were able to maximize the capital we had in the market. At the same time, we also bought BHI. We sold that today, actually, while it was up, but we still only gained a break even. Maybe we bought it at 70, 76, and sold it at 71.20. So we really only picked up 40 cents on this. So really just a break even trade. I liked our profit on XOP and the way the market is going. If you've been watching us, we've been selling into strength. As the market was going up, we were adding to our positions. As the market has hit this resistance, we have been selling into strength. We are now down to only having 25% of our stock funds invested, so 75% of our stock funds are in cash at this point, and we'll be watching carefully. We have SLV, which is a little bit of a hedge. They came up quite nice today. Again, we buy this anytime it gets down in the $18 area. So we've been purchasing through here and adding up quite a bit. And we'll go ahead and take some money when we get somewhere between the 5 and 10% profit on that. Actually, if we could get a move up here to the moving average, we'd have a nice little run. So looks like about 19 would be a good place to take our money. The other thing, this is a little bit more technical. I'm not going to get too far into it, but let me see if I can find it on. Okay, so this is called the VIX, V-I-X. It's also referred to as the fear index. So typically when you get spikes like this, the market is having a pullback. When you get down here, the market is not very volatile. And so the other saying is when the VIX is low, like here, it's time to go. And when the VIX is high, it's time to buy. So here we're moving up and probably at market highs. And here we're moving down and probably at market lows. So we purchased options on this. So if the market does continue its move down, this is most likely to go up. We purchased some call options. You cannot buy this outright. There's only a few ways you can purchase it. So not to get too technical, but we did purchase some call options, and that is a good hedge against any move down. And statistically, this doesn't stay below this 1350 line for very long periods of time, and we're already in that area. We started buying calls right up over here in this area, so we've actually had them for a couple weeks, and we were going to add to them yesterday, and would have been nice if we had. And just to give you an example, the blue line is the S&P 500. The white line is the VIX. So as you can see, the VIX peaked and the market had a dip. The VIX peaked, the market had a dip. The VIX peaked, the market had a dip. As the market's going up here, the VIX is going down. And as you can see, as the VIX is coming up, the market's having another little dip. And here we have our peak. And here we have a pretty good sized dip. It might be hard to see with the colors, but that's a pretty good sized dip. We have a little dip here with a nice peak, another little dip with a nice peak. And now look how far apart these are. They have not been this far apart in over a year because this is a longer chart. So we are actually at extremes in a relationship. There is not a one-to-one relationship in these, but we're pretty far apart, and statistically it's time for them to move together. So that's a pretty low-risk option trade. It's one of the few times we actually purchase options. We prefer to sell options, but that would be a good trade. So speaking of which, in this environment, the strategies that are going to work the best are going to be really short-term strategies. And if you're not, if you're not adept at swing trading, short-term trading, it's best if you're a long-term trader to either, just stay in your cash to see some evidence that we have made some type of bottom in the indices. if you are going to purchase, try to purchase using less capital per trade. Try to purchase less volatile stocks. So, try to purchase something more, of that nature than something of this nature. Now, if you like volatility, then you can play this, but I prefer to put a little bit less money into something that is a little bit less volatile. Try to pay attention to your overbought signals, whether using a MACD or moving average or just a candle analysis as to that. But simply just kind of watch your money right now. It's coming on to the summer, and things are often slow. And again, there's a difference between selling and not buying. And the institutions may just sit out the summer. Everybody's has made a good chunk of money in the past, and that's a good time to go on vacation for them and let the interns run the show. And so things can be slow, or if things like Iraq or Russia heat up, then you could have a much more severe pullback, and you just don't know. So it's better to protect yourself than find out the hard way. And so finally, I'll give an example of a low volatile trade that we're looking at, and this is more of an investment than a trade. And again, for us, an investment just means we're planning to hold it for a longer period of time. And we usually like to make some income on those types of trades. So I'm going to go ahead and pull up VNQ. And this is the Vanguard, as you can see up here, Vanguard REIT ETF, Real Estate Investment Trust. The Vanguard Real Estate Investment Trust ETF. So right now, this has about a 3.5 or 3.7% dividend. Let me go and look at my other screen here. Oh yeah, right now we're getting a 3.64% dividend, basically $2.34 per share per year from owning this REIT or this ETF, whichever you'd like to call it. Now, also in a market like this, we want to let the stocks come to us. We do not want to chase stocks. So in this case, you can see this is very much acting like the SPY. As a matter of fact, we could go over and find our chart here. We will take off. We'll change this to VNQ. So there's 1 year of the VNQ. I haven't looked at this, so I'm not sure what's really going to come up. And we're going to add the SPY to the studies. So you can see this acts very much like the market. So the white line, again, is the real estate. And we did have a little divergence here, but for the most part, it's acting very much like the market. So we should continue to expect it to act like the market. So we'll go back to our chart here. And what we want to do is we want to let this come back to some place where we think it has good support. So the first level I'm going to look at is probably right in here, this line at about 71.5. We might start purchasing some in that area. I'm going to open this up to a little bit longer chart and go out to a 1 year chart. So we can see we have about 7150 support and down to 70, and then again off this peak here down at 69. So basically anywhere down from 71.5 down to about 69, in our opinion, is a good entry area for this stock or ETF. Buy yourself a position. Well, that's not a recommendation. If you do your own due diligence and choose to, then you do what you feel is proper. But we would be looking to enter part of a position in that area. And if it continued to pull back, we would probably purchase more, intending to hold this for a long time. Looking at the business cycle, which is a whole other discussion, but looking at the business cycle, this will eventually, most likely, return up to its highs up here. So while your money is sitting there, you'll be collecting, the actually, you'll be collecting more. It's 3.6% now, but as it pulls back, that percentage, your return, your dividend is going to increase. You'll still get the $2.34 a share, but when you divide it by, and now when you divide it by 74, you get 3.69%. When you bought it at 70, maybe you'll be getting 4%. So if you're getting 4% on your money while you're sitting and waiting, and you can pick it up, just say you can pick it up at 70, and then you can let it run back up into this area and sell it for 73.5, then you can pick up another 5% on your entire holdings. So, if you're stuck holding it for a year, then you're collecting your 4% and even more if it goes down and you buy it and it runs back up. You're going to make the percentage on the appreciation of the actual ETF as well as the dividend. Things like this, sometimes they say have a dividend floor. When the dividends get high enough, people start buying them because the dividend's pretty high. A 3.5% dividend is not high enough for a dividend floor. There are, I can't for some reason think of the name of them, but there are ETFs where people are, say, pumping oil and you're getting revenue stream from the real estate, from the oil that's going out, and those dividends are usually quite high. Those are usually very volatile. One of those would be BPT, and as you can see, people have been buying the heck out of this. And look at this beautiful hammer down here. That's just doesn't get any prettier than that. Down, booming up. So there's your hammer lesson for today. And I'm just going to look over here on my other screen and see what BPT is bringing in. So this is a 9% dividend. Actually, it's a 10%. Yeah, I'm sorry. This is a 9% dividend per year. And you receive a per barrel royalty. Basically, this is owned by BP, and it has to do with an Alaskan oil field up in the North Slope. So basically, you're collecting the oil that's coming down from there, and especially with the geopolitical aspects of life today, people are liking this, and I'll tell you, 10% dividend is big time. And if this pulls back at all, we may watch this ourselves here for an entry, because if you get down here, you're going to be into a 12% plus dividend. Again, this is much more volatile. Probably, if I had been watching it, should have been entered back down here. Now, just to also show you that IYR looks exactly the same as V and Q. They're both real estate trusts. IYR has higher volume. It's more recognized. I like Vanguard, and this has become more recognized REIT. I was trying to find some support here on this 50-day moving average with this pullback, but in short, look for something not extremely volatile. Put less capital in your trades. Let the trade come to you, and you know, try to stay as much as you can with the direction of the market, and hopefully you should do well with that. If you have any questions, again, this is Stefan. Contact us at tradingcandles.com. We look forward to hearing from you. Happy trading, and good night.